We are back, chapter 8. We are up to video 5, where we're going to talk about auditing property, plant, and equipment. Alright, so PP&E, big stuff, high dollar stuff. It's your factory, it's your warehouse, it's your manufacturing robots, it's your desks, it's things you can see and find. So, in any given year, remember we're talking about expenditures and purchases and things, there's not that many things that are going to be added or sold out of inventory, or disposed of, maybe not sold, but maybe sold. So there's not a lot of changes going on with it. So it's in some ways it's easier. You've got a few high dollar things. They should be pretty easy to track. They should be pretty easy to find and look at, right? It's like, oh, a factory, there was a building. Yeah, right. So you're not so concerned with some of these things like you might be with inventory or finding understated liabilities, things like that. It's something pretty easy to find. All right. So the main thing that's hard to find is an unrecorded disposal. So they've gotten rid of something, and so it's still in the books as an asset. But again, you've got your listing of assets. You can find it, like say, oh, hey, this is material. Is it here? Or go look. All right. So typically, you're going to have a listing of PP&E, and you can compare their purchases and disposals, and then see if the stuff is there or not, right? So you can vouch to make sure that it exists, right? So you make sure you vouch for overstatements. You just go and you see if it's there. You do need to inspect titles. Remember, this part of the cycle will also have leases in it. So if they are leasing a factory, that building is going to look just like a factory they bought, right? A mechanical robot's going to look the same whether it's leased or purchased. So you got to check and make sure they own it, right? That's rights and obligations assertion. So you do have to make sure they actually own it. So you look at the title, or purchase orders that show they purchased it, things like that. The value of PP&E can change after purchase. If you have the kinds of expenses that you capitalize, right? I do something that makes my PP&E longer lived, I can capitalize that, right? So I think of a robot and I use some supplies on it, you oil it, do maintenance things, those are expenses. But if I take that robot and I retool it so that it's going to last longer, it's going to make something new that I can capitalize. So make sure that what they're capitalizing and adding to their assets are actually not expenses, right? Recalculate any disposals. So you should be able to tell from looking at their asset schedules what they've sold or disposed of or destroyed or what you just don't use anymore. Make sure they're not something that's obsolete, right? You can imagine in this day of high technology that things become obsolete and worth nothing, but they haven't been fully depreciated. So, you're making sure that that you're basically making sure that this PP&E is what they say it's worth, what it say it is, and they're not still carrying something on the books that isn't any longer theirs. So you should agree balances, examine insurance. This is a great way. Insurance and property tax records, they're not going to pay insurance on something they no longer have. They might keep that thing on the books, but they'll definitely take it off the insurance policy and take it off the tax rolls because they don't want to pay more on it. So if they're not paying the taxes or insurance on it, then they probably no longer have it, and you make them show it to you. So you can physically inspect things to make sure they exist. Depreciation is a great way to overstate your assets and understate your expenses, right? It's a non-cash expense. Who's to say what the useful life is? Well, your clients are supposed to say what the useful life is. Your clients are supposed to estimate a salvage value, right? And that's what they use to come up with their depreciation expense. You should see if it's reasonable, right? So you recalculate it, you evaluate that stuff. And if it's not consistent, if they're not doing it, then you're gonna find out, okay, are they understating depreciation? Typically what they want to do is understate depreciation expense. You don't find a lot of overstating depreciation expense, because what this does is two things. It lowers their expenses, so their net income looks higher, and it overstates that asset value, so that's a bonus, right? And it's all an estimate, so who's to say? So that's where you have to see how they're doing. Leases. So remember, your client could be leasing something out, in which case they own it. It's an asset for them. But where is it, right? So you might have to take that. Or they could be leasing something that if you walked on the factory floor and looked at that robot, it would look like it was theirs, but really it's not. So you have to figure out, is this a lease? And then if it's a capital lease, or the appropriate liabilities there, is there proper disclosure and footnotes, things like that. So you do have to figure out about leases. And so typically your client will have some kind of depreciation schedule, some kind of fixed asset schedule, and you can get those and you can compare the balances, and you can go make sure those things are still there, right? So very typically you'll start with the client's documentation and then just follow up on it yourself, right? Use your professional skepticism to figure out what's really there and what's not. All right, so we have one more video for this chapter, and when we come back, we'll talk about other expenses, but we're not going to talk about payroll.